Looking for the absolute best high-dividend aristocrat ETFs in 2025? Whether you're aiming for balanced growth and income or seeking reliable long-term dividend payers, these ETFs can provide both income and stability. But here's the catch. While dividend-paying stocks offer a safety net during volatile markets, they often lag behind high-growth stocks like Nvidia, Tesla, and supermicrocomputer. That's why many investors have a love-hate relationship with dividend ETFs. They can provide a steady income stream, but their slower growth may leave you questioning whether they are the right move. In this video, we are breaking down the top dividend aristocrat ETFs for 2025, exploring their strengths, weaknesses, and which ones might be the best fit for your portfolio. And stick around to the end to find out which ETF could be your best bet for long-term gain. 2025 is shaping up to be another unpredictable year for markets. Inflation, interest rate cuts, and geopolitical risks are dominating headlines. So how do you invest smartly while still sleeping well at night? That's where Dividend Aristocrat ETFs come in. These are not just any dividend stocks. They are made up of companies that have proven themselves by increasing dividends year after year, even during recession and crashes. Now let's dig deep into the top aristocrat ETFs that could help protect and grow your portfolio. Per-share S&P 500 Dividend Aristocrat ETF, NOBL. This is a classic choice when it comes to dividend consistency. It only includes S&P 500 companies that has raised dividends for 25 years straight, with 66 stocks and no single company making up more than 1.78% of the fund. You get great diversification. This means if one company slips up, it won't drag your portfolio down with it. But here's the trade-off. The yield is just 2.1% and the expense ratio is 0.35%, a bit on the higher side. It performs best in bear markets but tends to underwhelm in high-growth years. This is best for conservative investors who want rock-solid dividend growth, even if it means missing out on tech-fuel upside. iShares Select Dividend ETF, DVY. If yield is your top priority, DVY might be your best friend. With a 3.7% dividend yield, it's among the highest-paying aristocrat-style ETF out there. It tracks the Dow Jones US Select Dividend Index and holds 90 high dividend paying stocks. You'll find names like Altria, AT&T, and International Paper in its top holdings, classic dividend machines. While the expense ratio is 0.38%, its turnover is a relatively active 17%, meaning the fund is constantly optimizing. This ETF leans more towards utility and industrial stocks rather than high-growth tech. DVY is best for income-first investors who don't mind less tech exposure in exchange for generous, reliable dividends. Investor Dividend Achievers ETF, PFM. PFM is your middle ground, offering a taste of dividend growth and stock appreciation. It tracks companies with at least 10 consecutive years of dividend increases. With 422 holdings, including big names like Microsoft, Apple, and Broadcom, it tilts more growth-oriented than some of the others on this list. While its current yield is just 1.6%, it posted a 17% total return in 2024, outpacing its category average by nearly 3%. This ETF is built for investors who want exposure to high-quality tech and dividend growth. PFM is best for long-term investors focused on compounding wealth through both dividend increases and capital appreciation. Number 4 is SPDR S&P Dividend ETF, SDY. SDY brings something unique to the table. It's weighted by dividend yield, not market cap. That gives more weight to companies that pay high dividend regardless of size. It features stocks with 20-plus years of dividend growth, and its 2.6% yield sits comfortably in the sweet spot. It has a mid-cap tilt and a 55% turnover rate, which means more frequent rebalancing to stay in line with its high-yield strategy. Notably, in 2022, while the S&P 500 dropped 18%, SDY declined less than 1%. That kind of downside protection is a major win. This ETF is best for investors who want high-yield payouts with an added layer of mid-cap growth potential. And then there is Vanguard Dividend Appreciation ETF, VIG. VIG is the most cost-effective fund on this list, with a minuscule 0.06% expense ratio. It follows the S&P US Dividend Growers Index and includes companies that consistently raise dividends over time. It holds 337 large-cap stocks like Microsoft, Apple, and Broadcom, and manages over $88 billion in assets. With a beta of just 0.84, it's also 16% less volatile than the overall market. Yield-wise, it's at 1.7%, so not a huge income generator, but its strong price performance makes up for it. VIG is best for growth-focused investors who want a low-cost, low-volatility path to long-term wealth. So what's the verdict? If your goal is to maximize income, DVY stands out for its juicy 3.7% yield. Prefer a more growth-oriented approach with tech exposure? Then VIG or PFM could be better suited for your portfolio. Want steady dividend growth and lower volatility? NOBL is the classic choice. And if you're after a little of everything, income, growth, and balance, SDY offer a compelling mix. Ultimately, the right Dividend Aristocrat ETF depends on your personal strategy. Income now versus appreciation later. It's your call. Which dividend ETF are you considering in 2025? Or are you thinking of building a portfolio with multiple ETFs for balance? Let me know your pick in the comments below. I read and reply to every single one. And hey, if you found this video helpful, don't forget to like, subscribe, and ring that bell so you never miss a chance to level up your investment game. Until next time, stay financially savvy. I'll see you in the next one.